BAF 811 Corporate Finance Module 1 Study Session 3 Financial Statement Analysis. The expected duration of this study session is 1 week. Introduction. Having established the meaning of corporate finance and time value of money concept, it is needful at this point to discuss the usefulness of a financial statement in gauging the health of the firms being managed. Therefore, the objective of this unit is to look at how one can use these financial statements to analyze a company's overall performance and assess its current staffing standing. As we proceed in this session, you will learn about financial statements and their constituent parts, usefulness of financial statements, requirements of a good financial statement, financial statement analysis, and financial ratios. Learning outcomes. By the end of this session, you should be able to ascertain the relevance and users of financial statements, examine the qualities of financial statements, identify the tools of financial statement analysis, and discuss the uses of financial ratios in interpreting financial statements. Meaning of financial statements. A financial statement is a written account of the financial transactions of an organization for a specified period of time, usually 1 year. The financial statement of a corporate entity consists essentially of a notice of annual general meeting, chairman's statement, director's report, audit committee's report, auditor's report, statement of accounting policies, statement of financial position, statement of income, cash flow statement, notice of financial statements, value-added statement, 5-year financial summary. The preparation of financial statements of banks is governed by the provisions of Banks and Other Financial Institution Decree, BOFID, number 25 of 1991, in conjunction with CMD 1990, now referred to as ACT. The financial statement of unincorporated entity may consist essentially of statement of accounting policies, statement of financial position, statement of income, cash flow statement, notes to the financial statements. Cash flow statement is a statement prepared essentially to explain the reasons for the increase or decrease in the cash and bank balances of the company. It is otherwise called source and application of fund statements or funds flow statements. It indicates where the cash came from and how it was used. It answers such questions as: what has the firm done with the money it has? What will it do with new funds? How will it repay its loans? If the statement is analyzed on pro forma or projected basis, it shows how a firm plans to acquire and employ funds during some future period. When a transaction causes the assets to decrease or the liabilities to increase, it is a source, otherwise it is an application of funds. This statement is often presented with the balance sheet and profit and loss accounts as an integral part of financial statement. The inclusion of such statement is useful to improve the understanding of the operations and activities of an enterprise for the reported period. It is also helpful in evaluating the strengths and weaknesses of the company's financial position. A cash flow statement is divided into 3 parts. These are: 1. Cash flow from operating activities, which is profit before tax plus adjustments for non-cash items like depreciation, profit or loss on disposal of fixed assets, etc. Cash flow from investment activities, which includes proceeds from disposal of fixed assets and investments, purchase of fixed asset investments, and cash flow from financing activities, which includes proceeds from issues of shares and debentures, redemption of shares and debentures, and payment of dividends and interests. Value added constitutes the difference between the monetary value of output and input of goods and services attributable to business. It's an alternative way of preparing the profit and loss account. The purpose of value-added statement is to show the distribution of value added among various stakeholders such as employees, government, shareholders, known creditors, etc. Advantages of the value-added statement are: it provides a measure of the size of an organization. It is easier to understand. It provides a measure of the performance of an organization. It can be used as a basis for wage negotiation. It can be used to evaluate the relative reward of stakeholders. And it can be used to evaluate the social performance of an organization in terms of taxes paid. Basis for preparing a value-added statement. Two bases can be employed to prepare the value-added statement. These are: 1. The gross basis. Under this basis, depreciation is considered as a distribution of value added. 2. Net basis. Under this basis, depreciation is considered as part of bought-in materials and service. Special points to note: investment income, extraordinary items, and share of profit of associated companies. When there is investment income, extraordinary items, and profits from associated companies, the value-added statement will be divided into two parts as follows. Part 1. This part will show value added by trading activities, which is sales less brought-in materials and services. Part 2. This part will show the value for distribution, which is value added by trading activities plus investment income, extraordinary items, and profits from associated companies. Please refer to your online course study manual for an image of the value-added statement format. Gross basis. Note: bought-in materials and services, company's cost of sales plus all operating expenses exclusive the following expenses: wages, salaries and other employee benefits, interest of loans, depreciation of fixed assets. Question: itemize the constituent parts of financial statements. Answer: the financial statement of a corporate entity consists essentially of notice of annual general meeting, chairman's statement, director's report, audit committee's report, auditor's report, statement of accounting report, statement of financial position, statement of income, cash flow statement, notes to the financial statement, value-added statement, and 5-year financial summary. Relevance and users of a financial statement. Each business entity should produce information about its activities because stakeholders such as shareholders, bondholders, bankers, lenders, suppliers, employees, management, trade contacts, government, financial analysts, and advisors all need to monitor how well their interests are being served. They rely on the periodic financial statements of business enterprises to provide the basic information on the profitability of the business. They have invested their scarce funds in the business and want to see them efficiently managed. Therefore, they continually measure the performance of the business to determine the extent to which their interests are protected. For instance, creditors are generally interested in the liquidity of the business, whereas the shareholders are interested in its profitability. That is, they will want to know how effectively and profitably management is running the firm's operations and how much profit they can afford to withdraw from the business for their own use. The management needs information to enable them manage the business better. Suppliers of goods, on the other hand, will want to know the company's ability to pay its debts. Purchasers of the company's product will like to secure the source of supply so that they will not be thrown out of business suddenly. Government may need the statement in order to assess the tax liability and other social responsibilities of the company. Employees' future depends on the state of the company. Therefore, they have a right to the company's financial statements to guide them in making their demands. Financial analysts and advisors need it in order to guide their clients well. Financial statement analysis is relevant and useful in the following areas: in making judgment and building opinion, in forecasting the state of a firm, in decision making, in planning, in performance measurement, like obtaining solutions to the following questions. How efficiently does the firm use its assets? Is the firm in a position to meet its current obligations? Do investors consider the firm profitable and safe for the purpose of investing in the shares of the firm? Are the earnings of the firm adequate? Is there any danger to the solvency of the firm due to the use of excessive debt? Question. Differentiate between cash flow statement and value-added statement. Answer. Cash flow statement is a statement prepared essentially to explain the reasons for the increase or decrease in the cash and bank balances of the company. It is otherwise called source and application of funds statements or funds flow statement. Value-added statement constitutes the difference between the monetary value of output and input of goods and services attributable to business. The purpose of value-added statement is to show the distribution of value added among the various stakeholders, such as employees, government, shareholders, known creditors, etc. Users of financial statement analysis. The users of financial statement analysis include the investors for portfolio decisions, management for operational and financial efficiency evaluation, lenders for assessment of creditworthiness of a firm applying for credit facilities, regulatory agencies for control, economic and business researchers for studying the firm's behavior and trends, trade creditors for determination of firm's ability to meet claims, and labor unions for establishing an economic basis for collective bargaining. Question. Who are the users of financial statements? Answer. The users of financial statement include shareholders, potential investors, creditors, regulatory authorities, researchers, employees, among others. Qualities of financial statements. The corporate financial statements need to have the following qualities. They need to be relevant, comprehensible, reliable, objective, timely, comparable, and complete. Tools of financial statement analysis. The techniques of the analysis employed will depend on the requirements of the interested parties. For instance, shareholders and prospective investors are primarily concerned with receiving secured return on their investment, profitability, stability, and growth potential. The creditors are concerned with the security of their debt or loan and therefore look at the firm's liquidity in order to determine the amount and period of credit they will consider prudent to allow. The firm's management is concerned with the trend and level of profits since this is the main measure of their success. Bank managers and financial institutions, professional advisors to investors, financial journalists and commentators, tax inspectors are interested in the liquidity, profit potential, and ownership of the firm. The employees are interested in the longevity and growth of the firm and its ability to pay salaries, wages, and other benefits and demands. Customers are concerned with the constant supply of the firm's products, while competitors are interested in comparative performance of an industry. To accommodate all the interested parties, financial ratios are calculated and used to measure the strengths and weaknesses of a firm's financial position. The starting point is to select and calculate the important ratios. Then, use some good dose of good thought and judgment, that is, dig behind the figures to compare the financial ratios obtained with the firm's ratios in earlier years and with the ratios of other firms in the same business. The benchmark for assessing a firm's financial position is the industry average, but there is no international standard for financial ratios. Trends and relationships with past operations can be derived and studied for the insight that they may afford the financial manager in the conduct of his current and future activities. The process of comparison and evaluation or interpretation of financial data for the firm is facilitated by the fact that accounting principles and practices are relatively standardized. The basic financial data to which financial analysis is applied are found in the balance sheet and income statement. From the year 2012, the balance sheet and income statement were renamed Statement of Financial Position and Statement of Comprehensive Income, respectively. The balance sheet is a statement of the condition of a firm as of a given date. It is a summary of changes which have occurred since the last statement was compiled. The income or profit and loss statement indicates the firm's revenues and expenses and the difference between the two, which is the firm's profit. Another statement of value to the financial analyst that can be derived from these basic financial statements is the cash flow statement. This is a summary of the source and application of resources for the same period covered by the balance sheet date on which it is based. In computing cash flow statement, any decrease in asset or increase in liability or net worth item constitutes a source of fund. Conversely, any increase in asset or decrease in liability or net worth item constitutes a use or application of fund. The sources and uses must equal each other. The statement is useful both as a tool of analysis and as an aid in financial planning. It has been discovered that uncertainties which most investors face result from factors unique to the specific firm, factors related to the industries and geographic areas in which the firm operates, factors related to national, economic, and political atmosphere, and factors related to international economic situation. It has been discovered also that proper evaluation and analysis of financial statements can provide indicators which, if properly handled, will suggest the impact of the above factors. Financial analysts often compare information about a firm with other firms, industry-wide averages, market or economic-wide averages, international economic information, and standard ratios. The principal objective for this is to help the analyst determine whether the operations of a given firm being analyzed will move with, against, or independent of development in the above information under which it operates. Based on these discoveries, may I ask, what is financial statement analysis? Financial statement analysis is a process of sifting, sorting, and rearranging data on an entity and applying various tools of economic analysis to the data to formulate expectations and judgments on the strengths, weaknesses, opportunities, and threats of the entity. Financial statement analysis can be level analysis or time series, that is, trend analysis. Level analysis can be cross-sectional or standard ratio. Cross-sectional analysis is when the evaluated financial performance for an entity for a specific financial year is benchmarked or compared to the average performance in its industry or some other ideal benchmark. Standard ratio analysis is where comparison is made with standard measures or ratios. Level analysis can only be made among comparable firms having the same characteristics, namely, the same industry group, similar size, similar accounting methods, and located in the same geographical area. Time series or trend analysis is the use of historical trend in performance to provide a good basis for predicting future prospects or ratios. It entails selecting a base year and expressing the financial statement items of subsequent years or accounting periods as percentages of their values in the base year. The firm's trend is later placed side by side with that of the industry in order to know the specific or industry factors that caused the noticed trend. The tool of financial statement analysis include spreadsheet, which is a worksheet that classifies account balances and formulae in the order of financial statements in which they belong or relate. The analyst uses the balances as he or she pleases to derive whatever relationship that he or she desires and adjust any figure to suit his or her purposes. Common size statements. Working capital analysis, which is the analysis of that portion of total funding needed for the day-to-day operations of an enterprise to avoid the dangers of inadequate working capital and problems of excessive working capital. Dangers of inadequate working capital include poor returns to investment due to inefficient utilization of fixed assets, stunted growth as the firm is forced to operate below capacity, operating plans suffer due to insufficient resources, loss of confidence, trust, reputation due to failure to meet obligations, and operating inefficiency. Problems of excessive working capital include poor profitability due to idle assets that are barren of cash income, unnecessary inventory accumulation resulting in obsolescence and subsequently inefficiency may result. Cash flow statement, trend statement, financial ratios. However, in this book, the area of concentration is on the use of financial ratios to analyze financial statements. Question: what is financial statement analysis? Answer: financial statement analysis is the process of sifting, sorting, and rearranging data on an entity and applying various tools of economic analysis to the data to formulate expectations and judgments on the strengths, weaknesses, opportunities, and threats of the entity. Financial ratios. A ratio can be defined as a relationship between one quantity and another. In financial parlance, it is regarded as the relationship between two financial figures. For instance, the ratio of profit to sales shows how much profit is made on each naira sales. Financial ratios are useful because they summarize briefly the result of detailed and complicated array of figures presented in financial statements. They are used to evaluate the change in the firm's operations and performance over a period of time. Ratio analysis serves as an aid to apply in judgment to an otherwise complex situation and not a substitute for sound judgment. Classification of financial ratios. Profitability ratios. These are the ratios used to measure the overall profit performance of the company. The ratios can also be used to determine whether the profit made by a company during an accounting period is adequate or not in terms of capital employed or invested. That is, the ratios are used to measure the return on investments. Profitability ratios can be divided into primary and secondary ratios. The primary ratio is the return on capital employed. The secondary ratios are profit margins, which consist of gross profit margin and net profit margin, return on shareholders' funds or equity, operating ratios, which consist of cost of sales and individual expenses ratios. Liquidity ratios. These are the ratios used to measure how easily the company can lay its hand on cash in order to meet its short-term indebtedness as and when it falls due. A company should not be too liquid because it will pay some penalty by way of lost interest on cash tied down. On the other hand, a company should not lack liquidity because it could go out of existence due to lawsuits, bad credit rating, total loss of customers' confidence. The ratios used to measure liquidity are current or working capital ratio. The ideal here is 2:1. Liquidity or quick or acid test ratio. The ideal here is 1:1. Liquidity ratio, cash flow coverage. Since stocks and debtors must be converted into cash, it is necessary to measure the speed with which they are converted. This is especially necessary for stocks, which must be converted into debtors before conversion to cash. The faster they can be converted, the more liquid they are. To measure the speed of conversion of stock holding period is calculated. To measure the speed of conversion of debtors to cash, average period of credit allowed to debtors is computed. Gearing or leverage ratios. These are otherwise known as long-term solvent ratio. They are the ratios used to measure the ability of the company to meet its long-term indebtedness as and when due, and also to determine the long-term stability of the entity. They show how heavily the company is in debt, or the extent to which the firm has been financed by debt. The need for leverage ratios are to answer questions such as 1. Are the earnings adequate to meet the burden of fixed financial charges? 2. To what extent do assets and net worth provide protection for creditors in the event earnings prove to be insufficient to meet obligation? The following leverage measures are used to assess the firm's position: capital gearing ratio, debt ratio, debt equity ratio, proprietary ratio, debt coverage, bondholder coverage, current debt ratio, financial leverage, time interest earned, and cash coverage. Management efficiency/activity ratios. They are the ratios used to measure the efficiency of utilization of assets to generate sales revenue. Financial analysis employs these ratios to judge how productively and efficiently the firm is using its assets. They include total asset turnover, or capital employed turnover, fixed asset turnover, net current asset turnover, or net working capital turnover, individual asset turnover, inventory turnover, day sales in inventory, etc. Investor or market value ratio. These are the ratios used to measure the potential and actual growth of a company. These ratios are relevant when taking investment decisions in the company, especially whether to buy or sell shares. The principal concern of the investor or potential investor in a company is likely to be the return which he or she will obtain from the investment. He may receive this by way of income from dividends, capital growth from an increase in the share price, or a combination of income and capital growth. These ratios include earnings per share (EPS), dividends per share (DPS), dividend payout ratio, plowback, growth in equity from plowback or retained earnings, dividend cover, dividend yield, earnings yield, price earnings ratio, net book value per share (BVPS). See Financial Analysis Questions in Core Study Manual. Session Summary. In this session, you have learned how to assess the financial position of a firm using 5 criteria, and these are profitability, liquidity, stability or gearing, investors' return, and efficient use of assets. To assess the profitability of firms, 2 ratios can be used, and these are the ROCE and the profit margins. To assess the liquidity position of firms, current and liquid ratios are usable. For the purpose of ascertaining the leverage level, the gearing ratios are handy to gauge the stability position of the firm in terms of debt and equity positions. To assess the returns that will be available to shareholders, DPS and EPS should be calculated. To assess how efficiently management has utilized the assets of the company to generate revenue, the stock turnover and assets turnover are computed. Other areas that would require further investigation would be availability of raw materials, any legal restrictions on the company, royalty of customers, royalty and quality of the staff company, operating capability of assets, etc. Congratulations on your successful completion of this study session. Now, attempt the self-assessment questions in the online Core Study Manual. Further reading can be found in your Core Study Manual.